Owning gold and silver can be a great way to protect your wealth from inflation. The only drawback is that your metal just sits there collecting dust or racking up storage fees. If you started with 100 ounces, you may end up with only 95 ounces 10 years later. But what if your gold and silver could do more? What if you could grow your ounces just like you grow your other investments? Now you can with Monetary Metals. Monetary Metals' innovative platform connects gold owners and businesses to provide clients with a yield of their gold and silver paid back in ounces of physical metals. You can earn up to 5% in the precious metals program, and if you're an accredited investor, you can earn 12% on your silver right now in the latest bond offering. All the interest is paid back in physical ounces of gold and silver directly to your account, so your total ounces grow and compound year over year. Go to realvision.com/metals to learn more about how you can make your metals work for you today. Hello out there, welcome to another edition of Macro Mondays, or should we say Tuesdays. We're recording and publishing this on Tuesday, of course, due to the US bank holiday yesterday. My name is Mikkel Rosenvold. I'm back in the studio. Great to be here, Andreas.
Congratulations, Mikkel.
Thanks a lot. Obviously, there was reasons for my absence the past 2 weeks. I became a father for the first time, but it's I have to say it's good to be back in the office and back in the studio rather than taking care of an infant. But anyway, it's really great.
You can rest assured, Mikkel, you'll get to love your work even more now that you're a father. It's a lot more quiet down here.
Yeah. It's been a tough time. We have a great show for you today. We're going to talk about another bazooka, not my daughter, but the Beijing bazooka, the Chinese stimulus, everything that's going on in China. We're touching on U.S. liquidity, and then we have a look at the week that just started. We're looking at very important numbers coming out of the UK and ECB meeting. So a great show for you. Before that, Andreas, this is usually the part where I declare that this is a sneak peek into our research at Steno Research, and that you can read much more there. But now, actually, if you're following Real Vision, especially if you're a subscriber, you can get even more of our content on Real Vision. You don't have to go to our website. We've begun publishing a number of our articles on Real Vision, so depending on your subscription level, you'll get access to that. So, Andreas, perhaps could you just put a few words to what can people expect out of this? What can the Real Vision subscribers expect out of this?
So, consider us a buy-side shop on the sell side. We're active in taking positions ourselves. We're very active around our risk management. We basically scan across all asset classes day in and day out according to our very, very neat nowcasting methods across a load of geographies. So we're active in all sorts of assets across all sorts of geographies, and we'll explain why we do as we do. That's the short and sweet answer to that.
Yeah. So obviously you'll get a lot more content like this, like what we present in the show. Some of it will be repetition. If you read all the articles and watch the show, it may be a little bit of the same. But anyway, that's what we're going to produce. We're really excited to partner up with Real Vision on this. And Andreas, we do have another project going on. It's exciting times for us. We can't reveal too much on this. If you follow Andreas on social media, you'll get news in the coming days. But we have a very exciting project that we're going to be launching. We'll talk more about that next week. I've had some questions whether this could be related to to your old promise of starting an OnlyFans account. I cannot confirm or deny that. But anyway, stay tuned for more on that. Really exciting times for us in many aspects, Andreas.
Yes. Let's see.
Let's see what it is.
And one thing I can promise, if I open an OnlyFans account, I will label it Macro Meets Micro. No more comments.
I wasn't prepared for that one. Well, anyway, Andreas, let's get straight to it. Exciting times for us, but obviously also very exciting times in global macro. We've entered Q4, a lot of talk about October, especially in crypto space, a lot of expectations, Andreas. And a lot of this expectation seems to be driven by what's going on in China, at least with a macro view to it. There's a lot of noise out there on the stimulus coming out of China. A lot of people are expecting China once again to be the savior of the world economy. What's your take on this Beijing bazooka that we got on Friday? Some labeled it.
Well, I mean, we had this fiscal briefing Saturday morning, right? European time and Chinese time. And I was in London last week talking to a lot of hedge fund counterparts, and I think a lot of Western investors had high hopes for a major bazooka from Beijing. Let's put it on on the screens here, a chart on the bazooka. I mean, it remains nowhere to be seen, in my opinion. So they talk a lot about the wallet size of their fiscal stimulus. They talk a lot about the wallet size of their liquidity stimulus via the central bank. But the short answer is that we've received minuscule packages from China in many ways. So on Saturday, they referred to a ticket size of a couple of trillion yuans. It sounds like a lot. First of all, it's in yuans, it's not in dollars. A lot of people get lost in that already there. But the second thing is that those 2 trillions, they are already issued. We're talking about a special bond issuance already issued. So these are untapped funds that were already part of the 2024 budget, basically.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It will cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
And if you look at the total issuance measured by this China bond statistics that we have on the screen now, they haven't really issued more than what they typically do. Of course, there's an upwards trajectory here, but it's not like they've, doubled or tripled anything here. They're issuing the same amount of debt that they've basically done last year. So my point is just that, I mean, they're asking regional governments to spend some of the money that they've already issued, but it's nothing new. It's old hat, basically. And I'm getting the same vibes around their monetary policy. They're trying to add liquidity, but doesn't really work. If you look at our nowcasting in a chart, in a couple of charts from now, Mikkel, here, this one. So we track stuff like metro traffic, box office sales, port congestion, road congestion, stuff like that in China. And we admittedly saw a spike after the first announcement a few weeks back. But it's already fizzling a little bit. And ultimately, what I'd like to see from China to turn much more structurally upbeat on the case is some sort of open-ended nature in their wallet size and a stimulus that will actually forcefully push through demand in the economy. Like either doing direct QE, whether you like it or not, it works if you buy assets, but they don't. Or if they announced open-ended fiscal transfers, like we had during the pandemic in the US, for example, just sending money to people, that works as well. But I mean, we had some handouts and vouchers here and there in the big cities, but that's all we've seen. And it's not open-ended. It's not like they communicate, okay, we'll send each household 1,000 yuans until this is over. That would be a strong message, but we're far from that.
Yeah. That was probably what I expected more of, and might still come. That would essentially mean that the Chinese government was transferring debt from the households to the central government. Yeah. If you would like that, depending on how the households spend this money, of course. But very interesting. Does this mean then, Andreas, because it seems like investors globally took on the Chinese fiscal stimulus quite positive on the China case. Are people wrong, or what do you see in hedge fund positioning on China?
So we've had a lot of flows going in and now also out of China over the past couple of weeks. I don't think we've seen a heavy positioning in China from real money players in the West. We had a lot of hot money flowing in to China over the first couple of weeks during the stimulus frenzy. But no, I mean, obviously the average hedge fund is still to a much larger extent positioned in dollar assets and euro assets to some extent. So no, it's not like everyone and their mother bought into this story. But if you look at the flows in a historical context, on the next page here, this is from the EFPR database, and we're talking about pretty solid inflows to especially technology in China. Over a couple of weeks, I mean, we're talking, 9 billions according to this measure. If you look at retail flows into ETFs, etc., we're also talking a handful of billions at least. So some Americans at least bought into this story.
There has been some buzz around this.
Yeah, absolutely. And I can still, if I say something negative on China on SoMe, I get like an army of people after me. So I still think a lot of people are invested in this. But let me show you a few charts on the technicalities of the liquidity additions and the equity support package. Because let's look at liquidity first. So they did a 50 basis points cut to the reserve requirements of banks. Like practically speaking, it means that banks need to hold less capital to lend out. So it basically freed up $1 trillion thereabout initially, day one, right? Because of reserves being freed up. But they're targeting the short rate in China. So if this trillion doesn't find a new home, it means that it puts a lot of downward pressure on the front end of interest rates, and they're not interested in that because it will weaken the currency a lot. So ultimately, they're mopping up that exact same amount of liquidity via open market operations. That's what you see from the red line here. The total of their open market operations is down, roughly $1 trillion. So to ensure that short rates do not fall through the floor, they mop up the same liquidity as they add, meaning that it's net neutral.
Yeah.
Nothing happens. Yeah. When you look at the equity support program on the next page, 113 billion, by the way, creating a 2 trillion market cap response. That's kind of hilarious in itself. But it's made up by two schemes. First scheme is a relending window, meaning that the People's Bank of China, the central bank, will deliver the liquidity to a bank lending out money to a corporate buying back shares. But you need to find a corporate willing to buy back its own shares after a 30% frenzy in the market. That's already debatable. You need to convince a bank to ease the credit rules sufficiently for the corporate to be willing to buy back their own shares via this loan. They have to pay for the loan, of course. And the bank will only earn a 50 basis point spread versus this facility. So would I, as a bank owner in China, lend out a lot of money to corporate buybacks for a 50 basis point spread now that equities have rallied 30% in, 2 weeks? No fucking chance. I mean, they're not going to utilize this window. I think it's useless. The other facility is a swap facility where they allow, for example, local asset managers to swap weak collateral for higher quality collateral. And the aim of that is to get leverage back in the system in China, because if you have better collateral, you have better collateral in repo markets, you have better opportunities of levering up your portfolio. But again, it depends on local asset managers being willing to put on more leverage. And if the market is not performing well, I'm not sure. So this is very far from actual QE. It's very indirect, and it depends on demand. And the demand is not strong.
So a theory I read out there, Andreas, is that we should essentially understand this as China entering a stimulus season, like we've been talking about the US cutting season.
Yeah.
Like more stimulus initiatives coming. Do you expect that? And what should you look out for? What would be a real game changer in this perspective?
So the NPC meets in a couple of weeks from now, Mikkel, and I'd like your take on that as well. So obviously they have the opportunity to present a new handful of initiatives there. Given how flows have looked over the past, say, 3 or 4 trading days, in all transparency, we're short China. I would argue that they will have to do more. Otherwise, this will end in tears. So yes, why not? I mean, they'll have to do more. The big question is whether they will do the right thing. And I'm very
hand
skeptical.
out money,
yes,
essentially.
Well, if they want to sell, if they want to solve this. short term at least. That's what they have to do. I don't think there is a strong structural case or fundamental case anyway. But if they want to reignite this momentum, they'll have to do more, and they have to do it open-ended.
Yeah. To me, at least, it seems like, and this is conjecture, but it seems like the Chinese government has realized that this whole operation on building growth through lending and construction is no longer working for them, and they've dived into what I would call the Western toolbox, or the Western economy toolbox. So how do we drive growth in the West? We send people some money and hope they spend it to really simplify things. So I think this is the path that China is on right now. Will it be enough? We'll see. They have some very firm growth targets for 2024 as well. Yeah. They might be able to claim that they've met them. Depending on how they control their own statistics, obviously. But I mean, they have to do something to spur growth.
Yeah. But I mean, assuming that they're actually on a path to do actual QE. It would probably be a bigger U-turn than Kamala has done on her policy. They've spent the last 10, 15 years telling us in the West that we were stupid doing QE.
Exactly.
So if they all of a sudden start doing QE, it's one hell of a U-turn, to be honest. And I'm not sure they're willing to do that.
So Andreas, tactically speaking, you say we're short China right now.
Yes.
Is there some money to be made from tourists getting excited by the buzz of stimulus or handouts? What do you need to look out for with regards to these meetings and announcements out of China?
Yeah, so as one of our counterparts put it, we're currently playing headline hockey out of China, right? So, I mean, every time the new headline shows up, all of a sudden Hang Seng spikes a percentage point or so. On Monday, we suddenly had a news story from the news agency, I think it's called Beijing, telling us that they would issue 6 trillion yuan's worth of treasury bonds aimed at stimulus over the next 3 years. And again, you need to take a deep breath, look at whether it's sizable relative to the economy, whether it's sizable relative to the debt market, and even 6 trillion is not a lot, at least not if it's spread out over 3 years. So every time you see a headline with a big ticket size or a big volume, ask ChatGPT whether it's a lot versus GDP. I mean, it's a good first step, right?
Good point. Very good point.
Because, for now, it's not really been a big thing, even though we're talking trillions. And it was even worse when Japan did so because of the weakness of the yen, right? They were talking trillions all the time, and then you had to transfer that back. Okay, we're still into the billions, right? So you know what I mean, right? You just need to find firm footing. And I'm not really sure whether they've done enough. That's the short and sweet answer to the initial question here.
So still short China, still our positioning in that environment. Andreas, I want to turn our heads back to the US a little bit and talk on US liquidity trends because you posted in your weekly article, which is also released on Real Vision from now on. You've been talking a lot about this liquidity tsunami coming on. We're still in that figure speech. What's going to happen in US liquidity over the past 1 to 2 months?
So, I mean, this chart, we're talking about actual trillions here.
We are. So, true trillions.
True trillions.
US trillions.
In hard currency, right? But joking aside, I don't know whether you can call it a hard currency anymore. But by the way, point being here that we have a couple of reasons to turn a little bit more upbeat on dollar liquidity now. Mm-hmm. First of all, the Treasury general account will have to be emptied ahead of the crossover date next year. So basically, the US Treasury cannot hold a lot of idle cash when the debt ceiling is in place, and it will be in place again in Q1. Mm-hmm. On top of that, they've started talking about the discount window as a liquidity facility on an ongoing basis. So they want to remove the stigma of that facility that you typically only use during times of stress. And I wouldn't be surprised to see them discuss this discount window opportunity already at the November meeting. By the way, in relation to that, on Thursday, the New York Fed will start publishing its gauge of reserves demand on their webpage. I think this is another hint that the policymakers within the Federal Reserve System, they've asked their bureaucracy to track whether it's time to add liquidity again. So it's not like we haven't seen a whole lot of liquidity being added yet, but the market is speculating that liquidity will arrive in size. And I ultimately also think that liquidity will arrive in size. And 5-10 years back, you would have needed to wait for liquidity to arrive to trade this. Now I'm a little bit less certain because, I mean, liquidity trends, they've been democratized. I've been a part of doing that. I've basically followed liquidity for my entire career. And that's why as soon as this is being telegraphed via various hints, right, left, and center, you should probably start taking care of it.
And how do you do that specifically?
Risk on. So maybe you can show the chart we have on MicroStrategy. At least up until Monday, it was rallying like there was no tomorrow. So, and then all of a sudden someone started selling a large chunk. But MicroStrategy is obviously this Bitcoin proxy with Michael Saylor in charge. And I mean, you guys out there probably have plenty of opinions on him. But point being that we're starting to see some signs of markets trading liquidity additions, both in the actual crypto space to some extent, but also in crypto proxies. And we're starting to see new highs in SPX. And I mean, it seems like there are reasons to turn more upbeat, I think, especially on assets in the US.
Very interesting. Andreas, let's have a look at some of the events of this week in global macro.
Yes.
Obviously, we're looking ahead at UK inflation numbers. You did this chart on hit ratio on betting on higher than consensus US CPI. You have to explain this to me. Is there a fold in markets' understanding of UK CPI numbers or what?
Well, that's actually a very good question. I mean, it's always been important to me to look at seasonality in eras, if you know what I mean. So this is essentially a heat map of when to expect the market to be wrong in either a low or high direction on UK inflation. We do these studies on the major inflation prints across the big countries. So when the light blue bar here is tall, it means that oftentimes the economists surveyed on UK inflation are wrong on the high side, so inflation ends up being lower than their projections. And if we look at the details from September in the UK on the next page here, I think it's worthwhile noting that typical seasonal patterns have been annulled basically because of the pandemic for a few years. So if you look at services in the UK, we typically see a drop. I mean, an outright decline of, say, 50, 60 basis points a month in September.
So month-on-month numbers.
Yes. Yeah. Likely driven by seasonal hiring dropping out and all that. But we haven't really seen that 3 years in a row. The expectation is that we won't really see it again this week. But the labor market is substantially weaker than it was a year ago, both in the US but also in the UK. It's not like it's been an outright catastrophe, but the trends are much softer. So if we just get some of that typical seasonal effect back in wages, we'll see a decline on the month. And that's kind of the direction I'm leaning in, which would allow UK inflation to print on the low side of expectations. Does it really matter? Well, I think it matters a lot. We'll get to the geopolitical overview in a second, Mikkel, but we've had oil prices falling off a cliff this morning. We've had inflation expectations coming down again. I think UK inflation will sort of solidify that trend towards lower interest rates again. We had a whole a parade of hawks from the Federal Reserve out during Columbus Day, talking about, okay, now the need is not really there to cut interest rates fast. Not that I disagree, but when they start talking about that, it's already in the price. So that spike high on interest rates, I think it's behind us now.
Very interesting. And just one more number next week, or one more event next week, is the ECB meeting.
Yeah.
One more cut and then neutral, or what's your expectations?
Yeah, I think they will cut and then tell the two of us and the rest of the macro environment that they're going to neutral. The question is, what is neutral in Europe? And I'd actually like to show a chart on German wages in relation to that, because a neutral rate, that concept is kind of bullshit if you ask me. But anyway, what we're trying to measure is the interest rate that keeps the economy in some sort of equilibrium, right? It's not accelerating, it's not decelerating. Currently, we're most likely above in the Eurozone, at least. I mean, growth is moving nowhere. Unemployment is slowly but surely starting to take up in forward-looking indicators. Wages are coming down. They may even outright decline in Germany next year. I don't think we've seen that a lot of times. No. And therefore, my overwhelming conclusion is that even considering the forward pricing of euro interest rates, we're not back at neutral. We're still above neutral. John Williams, the president of the New York Fed, is very famous for creating actually a pretty simple model for neutral rates. The Lordbeck-Williams model right now is at, I think, approximately 125 basis points in the Eurozone, and forward rates bottom out at roughly 2% in Euribor terms. So it's still almost a percentage point higher than neutral in forward pricing. In the US, the same estimate is 3.25%, which is more or less smack dab at where the market is pricing. Point in case here, if you want to buy fixed income, do it in Europe and do it ahead of the ECB on Thursday.
Very concrete and actionable, Andreas. Before we round off, I've been away for a couple of weeks, so I just wanted to touch on some geopolitical issues.
It's not like the Israelis have given you a paternity.
Not all, you have to admit. No. So just to draw up to current events. Obviously, we're looking a lot at what's going on in Lebanon. We talked about this before I went on my little hiatus here. Essentially, my reading of this conflict is obviously Israel has an interest in improving the security situation in the north of Israel. That's the very concrete specifics of this operation. But furthermore, and in my opinion, the main driver of this, which is being overlooked a lot, is that Benjamin Netanyahu and the Israeli government needed a victory, needed a win, a positive story. They weren't getting that out of Gaza. The October 7th massacre was a disaster for Netanyahu, huge embarrassment. He needs a win. It's not going to be a quick operation against Hezbollah, but it is more likely to be a win and not to drag Israel into a long negative war as the Gaza conflict. So that is one of the main drivers of Israel to be a little bit cynical here. And that's also why Israel has really pushed on with this operation, even though they are getting in conflict with UN troops there, UN peacekeepers, which is obviously adding to this erosion of Israel's support in the West. So this is, in my view, a very short-sighted operation, aiming at improving Netanyahu's chances of rescuing his political career, essentially.
Mikkel, overnight European time, we received headlines from, I think it was New York Times, citing some sources within the Biden administration for at least allegedly Israel has agreed to not strike critical oil infrastructure in Iran. Yeah. Is this Biden's wish, or how do you read that?
Yes, absolutely. I don't think Biden was very keen on the Lebanon adventure as well, but perhaps it seems to me some sort of agreement has been made. Obviously, Israel has been more and more independent in their decision making. So if they wanted to strike Iran, they could do it. But it's a much bigger leap than it's a big leap from attacking Lebanon to attacking Iran. They wouldn't attack Iran without U.S. backing. So essentially, that is probably the limit of Israel's independence right now. In exchange for that, it seems like the U.S. have begrudgingly accepted the Lebanon operation. They are still supplying Israel with weaponry and missile defenses and are more or less silently supporting this operation into Lebanon, at least for a couple of weeks more. The thing is that this torpedoes any chance of a peace in the region. That's completely off the table. We've talked about that all year. In my opinion, there's no path to that right now, among other things because Netanyahu needs a win, and as long as the war is going on, as long as he's making progress, he can point to the security situation improving for Israelis. There's really no point in making any kind of a peace agreement. When it comes to Iran, neither Israel or Iran really has a great interest in have a great interest in an all-out war, and I think that fear is being driven way too much up on social media whenever there's conflict between these two countries. We've seen Iran over the past few weeks open sending signals that they're open to talks on a new nuclear deal. So I think the U.S. administration is very focused on not having this escalate, and they're managing that very well so far.
So, Mikkel, back in April, when Iran attacked Israel with drones and rockets and what have you, it marked the exact peak of the oil price, basically the day after.
Exactly.
This time around, we had a major spike in the oil price after Iran attacked Israel again. Was that again the exact peak in the oil price?
Absolutely, because I think people overreact to these things. As I say a lot of times, this is the Middle East. It's very common for nations to throw missiles at each other. We're not used to that in Europe or North America. It would be a huge story, but that's just the way it happens in the Middle East. Sometimes you blow off a little steam by throwing some missiles and drones at each other. It doesn't mean that you're going to all-out war. So that is. Whenever these things happen, whenever Israel and Iran exchange missiles, try and keep level-headed, and don't fear this all-out war which is obviously what's inherent in these oil price hikes. So it seems to me, we can get back to the oil prices next week as well. It seems to me that a lot of factors are pushing prices down at the moment. See, Saudi Arabia has more or less folded in their attempts to drive up prices or keep prices higher, at least partially. So I think that is the trend from now on. To be very specific.
You make money by being an optimist, but you sell subscriptions by being a pessimist, and that's always been one. That's always been one of my main sayings. And here we are selling subscriptions, Mikkel, right? But we're just kidding, because we obviously have to make money ourselves as well, and that's probably the biggest hint I can give you ahead of next week, Mikkel. And one thing I'd like to add towards the end here is that, watching this geopolitical malaise in the Middle East for 3 or 4 months in a row, even more than that, since April, basically, it's been the forefront of all headlines coming out related to commodity markets. And I don't think I've made a cent trading those damn headlines. I mean, as I said on China, which is why I'm a little bit, being directionally short China is tricky in a cash position right now, because you're playing headline hockey against the Chinese authorities. Exactly. Yeah. It's the exact same thing in the Middle East here. You're playing headline hockey against Benjamin Netanyahu and against the Ayatollah in Iran. So optionality is always worthwhile considering when you're playing headline hockey, because then you're not caught wrong-footed if you're if the market move is against you based on a headline. But I think, setting all of this aside, the best risk-reward is basically in dollar markets. We have liquidity most likely upcoming. The market is starting to turn upbeat. And as per usual in these things, the US is pretty much the winner of it all. Isn't that fair to say? Absolutely.
Yeah. You have to say the US is in a very strong position down here. And I think, again, the most important dynamic down here is not Israel, Iran. It's Saudi-US. It's the Saudi oil production that's really driving oil prices in the long term. It's not these little flukes. So maybe we'll touch a bit more on that next week. But until then, keep calm. Even if more UN bases are overrun down here, it's not going to send oil prices skyrocketing.
And we need to remember our disclaimer now that we're talking about our ideas, Mikkel.
Yeah.
So both in relation to this show, but also in relation to our research piece is now distributed on Real Vision as well, to some extent. Remember that there...
Sometimes may be good, sometimes may be shit.
That is the best disclaimer you can get. We may put shit research out there from time to time. That's the honest answer.
That's the way it is.
Yeah.
I think that's pretty much what we had this week, Andreas.
Yes.
We'll be back next week with even more news and more coverage of global macro. Thanks to you, Andreas, for joining, and thanks to you out there for listening and tuning in. We'll be back next week.
Owning gold and silver can be a great way to protect your wealth from inflation. The only drawback is that your metal just sits there collecting dust or racking up storage fees. If you started with 100 ounces, you may end up with only 95 ounces 10 years later. But what if your gold and silver could do more? What if you could grow your ounces just like you grow your other investments? Now you can with Monetary Metals. Monetary Metals' innovative platform connects gold owners and businesses to provide clients with a yield of their gold and silver paid back in ounces of physical metals. You can earn up to 5% in the precious metals program, and if you're an accredited investor, you can earn 12% on your silver right now in the latest bond offering. All the interest is paid back in physical ounces of gold and silver directly to your account, so your total ounces grow and compound year over year. Go to realvision.com/metals to learn more about how you can make your metals work for you today.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.